Hello and welcome to MF Corner. I'm Sonal Bhutra, and with me as always is Vinnii Motiwala. We have spoken about the big Trump tariff data or the update that came by, and we have this series where we talk about our CIOs as well, or fund managers. Know your CIO, and that's exactly what we are going to do today, and understand what the larger impact on investments could be.
Absolutely, that's what we're going to be doing, and today that's the focus mainly. Understanding the strategies that they follow, investing in mutual funds, how do they actually decide on asset allocations? And at times when we see those 25% tariffs coming in, how do you analyze that? How do you, what do you tell your clients? How do you navigate the risk that you see in terms of market volatility, I beg your pardon? That's what we're going to be understanding. And today to do that, we do have Shridatta Bhand-Waldar, who is the head of Equities at Canara Robeco, who is the fund manager over there as well. He's handling a lot of funds. Shridatta, good afternoon. Thank you so much for joining in with us. First, let's just start with the basics in terms of understanding your investment philosophy. What do you all follow there? How do you all, evaluate equity strategies? Let's start with that.
Good afternoon, Vinnii. Thanks for having us on the show. I think interesting times, but before that, as you said, let us delve into how we look at basically our equities piece and in terms of the core investment philosophy. We as a house are fairly focused on basically underlying businesses, and thus the focus actually runs around what is happening in the business, the scalability, growth, capital efficiency, etc., rather than what is happening in terms of the narratives and noises. Having said this, from this clearly flows the core investment philosophy that we have, which is invest in robust growth-oriented businesses which are run by competent managements at a reasonable intrinsic value. These are and when you look at these factors, clearly the three key parameters come out in terms of the starting point or the core pillars of the investment philosophy are what kind of management or quality of management that you are dealing with, what kind of business that you are dealing with, and intrinsic value of the business, which should be reasonable rather than just the statistical cheapness of the factors that we look at. That is the starting point. We call it as BMV, business management valuation. From there, of course, once you have actually spent time on these things, so we have roughly 380 companies under our coverage. Each of the company, when it comes in the investment universe, it goes through the filters of actually checking in terms of, are we comfortable with the quality of management, are we comfortable with the quality of business, and are we actually okay with the balance sheet quality. Having said this, these are of course, the core filters in terms of getting the names in the universe. But beyond that, when the portfolio construction happens, predominantly the two key factors that we look at is incrementally. What is the incremental superiority or inferiority of growth in particular sector company that is happening versus the rest of the market? That is one. So incremental capital efficiency and incremental earnings growth. And when we say earnings growth, typically we also mean cash flow growth, not the pure accounting earnings growth. That's one. Second is also over last few years, the one factor we have started paying a little more attention to is clearly what we are observing, that understanding the positive or negative significant capital deviations, capital efficiency deviations or earnings deviations is becoming more and more critical because of the basically compression of the business cycles. The business cycles are compressing predominantly because of effectively the abundance of capital that is available, which you guys are observing. Equity is very easily available. The distribution network democratization has happened, and a customer who's willing to actually experiment. And if all those three things are together, you are actually experiencing a lot of capital deviations, which can actually give an opportunity to save you money because the businesses can derate, or sometimes actually creates an opportunity to make a lot of money. And that's additional factor that we are looking at.
So, Mr. Shridatta, when we talk about markets currently, we've been talking about how high growth stocks as well. How are you balancing both? Talking about growth stocks, value stocks within your flagship equity funds right now?
So you don't overtly or actively try to manage the combination of growth and value. As a house, we have a mix of growth stocks as well as value stocks. But of course, as a house, we also have a tilt towards growth. Predominantly, the reason for having that tilt has been the abundance of growth that is available in India. If you actually just look back for last 25 years or 20 years in India, average nominal GDP growth rate is roughly 10%. And if you have so much of growth available, naturally, it makes sense to actually play on that part more as compared to the value. Having said that, we have nothing against buying relatively cheaper names or value stocks, but we don't want statistical cheapness. We typically tend to actually focus on buying value stocks when we know that there is a time bound, tangible and discernible driver in place, because you clearly need a earnings driver or capital efficiency driver to be in place for that value to get discovered. And when we get that, we are actually more than happy to add the stocks on the value side as well. But you don't overtly manage it. That's the starting point. Beyond that, whether it is a value stock or growth stocks, the starting point is always, are we comfortable with the quality of management? Are we comfortable with the quality of business? Are we comfortable with the quality of balance sheet? And beyond that, everything is what offers you superior relative earnings growth and what offers you superior relative capital efficiency. That decides whether you are buying into a value stocks or growth stocks. We are actually agnostic to either side, as long as some of these key fundamental tenets in terms of the characteristics as well as the growth parameters is in place.
Absolutely. That's interesting. But, at such a time, specifically today, we just saw that move coming in, right? 25% announced. Then you did see that sharp fall that was there in the market. We had a gap down start, then that recovery coming in. Now, your thoughts coming in on this tariff front as well. And how do you handle such periods as well, which come in the markets as well, whether it's volatility or underperformance? How do you manage to handle that?
I think volatility, outperformances, underperformances is a part of the game over a period of time. I've been around for 20 years now, and you've seen this multiple times. What we tend to focus on is, on relative basis, can we identify every year 10, 20 businesses which on a relative basis can deliver better growth, can deliver better capital efficiency? Because the rest of the stuff that we witnessed, and it's not that it is not important, but time to time we have seen that if you actually look back over last 10, 15 years, you had GFC, you had COVID, you had basically temper tantrum, you had Fragile Five. So you had multiple events, and still actually, if you had actually focused on, rather than focusing on a lot of this noise, if you had focused on actually owning good quality businesses which have compounded over a period of time, there is a lot of wealth creation that has happened. And that's what we are focused on. We are good at, actually, as a house, we believe that we are good at security selection, stock selection. Even during the periods of outperformances or underperformances or volatile times, we're more focused on identifying companies where we think there's an opportunity to actually differentiate ourselves in terms of our assessment of basically the cash flow or earnings growth, and actually play those opportunities rather than worrying about the volatility. Volatility is the name of the game. The first thing when one comes into equity market has to remember that equity is actually an asset class which exploits the land, labor, and basically cost capital to generate higher return than the cost of capital, typically, if it is well run. And that's where it has to have a relatively superior outcomes over a period of time. It doesn't happen every month, every day. That's what we are focused on. That's how we look at the volatility or underperformances which come from time to time.
Volatility, as you said, is the name of the game. The recent volatile event has been what we saw with Trump tariffs. How do you assess that situation currently? Do you think it could have a longer-term impact?
Our initial assessment, and nobody can call out how it will play out, but our initial assessment is it is transient. It's a negotiation tactics. There are certain aspects on which clearly India is stuck, and so particularly related to agri, which we can't give in. But our sense is over next 3-6 months it will settle at a lower rate, we in line with most of the other basically tariff deals that you have seen. Having said that, yes, in near term, for a month or two, till the time you have final settlement, you are going to have impact on certain sectors. Some of it is very, very well understood, like part of basically pharmaceutical, part of auto, part of textile, part of industrials. These are few of the sectors where you have few companies, not all of them. You have few companies which will get impacted for a month or two. As long as you don't change view and say this is here to stay at a much higher rate, which creates a disadvantage for India versus others, uh, uh, I think you should be okay. The problem, but our initial assessment is it is more transitory, probably 3-6 months, and you would also be largely aligned in terms of the trade deal as it has been with other large economies that US had.
Okay, on that note, actually, we're going to slip into a very short break. We'll continue this conversation after the break as well, so stay tuned in.
Welcome back. You're still tuned into MF Corner. We still have with us our guest, Mr. Shridatta Bhand-Waldar, who's the head of equities at Canara Robeco Mutual Fund. Mr. Shridatta, we spoke about what your strategy is, but in terms of spotting promising new sectors or business models, how do you do that in the Indian context? What is the entire process that takes place?
Sure. I think fundamentally the process is both bottom up and top down. Let me start with the bottom up because we as a house cover roughly 380 companies, and when we say we cover, which means we have our basic understanding, earnings models, and everything in place for all those 380 companies. So when you are doing the bottom up research, naturally you have a team of 18 people, investment team people, which is covering these 380 companies. And when you do that on daily basis, you have interactions, you have channel checks, you have management meetings, and as that happens, a lot of times you come across basically new companies, adjacencies where the opportunity is getting created. So that is one way of actually idea generation or opportunity creation that happens, where you identify businesses and then you actually dwell deep into it, and you take position sometimes, you don't take position sometimes, but that's a more bottom-up approach where it's the traditional research leads to new ideation. This other way, which is more top-down, whereby if you actually look at the long-term, Indian economy has been evolving, and as economy evolves, you have profit pools which emerge. There are a lot of profit pools which were not available 10 years back, which are there. For example, platform companies were not there 5 years, 7 years, 10 years back. In listed space, at least, those are there. Basically, exchanges were not there. Capital marketplace were not there. They are there now. So as market economy evolves, as market evolves, you get basically new profit pools that coming in. You have profit pool expansions. You have basically consolidation of profit pools in several sectors, where the consolidation of the sector happens. You have several sectors where the competitive intensity goes down and thus the opportunities get created. You have sectors where the value migration happens, and that's a big theme again, where the value migrates in terms of the profit pools migrating from one set of companies to the other. Fundamentally, you get basically effectively new opportunities or new sectors where the profit pools are either expanding or getting consolidated or migrating from one actually set of companies to the other set of companies, and that offers an opportunity to evaluate new set of companies where you can actually spend time and actually eventually come to find opportunities. So these are predominantly two ways to find opportunities or come across the opportunities in terms of new themes, new stocks, new sectors, which overpaid caps.
Shridatta, how should today, if someone wants to start investing in mutual funds, SIPs, what is the best allocation approach for investment that one should follow, a golden rule that comes in while starting, and the perfect asset allocation you would suggest in today's scenario?
First of all, there is no perfect allocation asset allocation strategy for anybody. But let me attempt to answer this question. I think the first starting thing is, and which most of the people ignore, is probably at a starting age or at a younger age, save more. So first starting point is, of course, save more. Second, decide your long-term, medium-term, short-term, long-term goals. Based on these goals, then you decide how do you do asset allocation. Of course, you have to take your advisor's view on this. But even before, when you do asset allocation, one has to be kind of fundamentally understanding himself or herself very well. Because when you do asset allocation, your asset allocation should be along your appetite of volatility, your appetite of risk, your expectation of return, one's expectation of return, and actually one's horizon. When you consider all these things, different allocations actually work for different people. For example, you might want a 15% CAGR over next 15 years. I might be comfortable with 12%. So our asset allocation will be fairly different. And it will be a reflection of our basically inherent personality and ability to take volatility. Everybody will make returns, but you need to have differentiation in that. I think that's very, very critical. And once you have that, then you start allocating based on the asset allocation that you have decided. Naturally, if you're starting young, uh, uh, and this is based on the past track record, you are generated something like 13-14% CAGR return in just the main Nifty Sensex indices over last 20 years. And if that is the base rate, then naturally, if you're starting young, where you don't have other liabilities and you have long runway ahead, the largest compounding is likely to happen in equities. And so to have a higher equity allocation, particularly when you're doing SIPs, actually is a better way to approach the asset allocation. Of course, as you grow in terms of age, you should have a different allocation as compared to that. So that's I think there is no golden rule. There is this basic stuff that save more, invest more, start early. I think that's what matters. What is more difficult is actually to follow it, because I think more than 90% of the people actually give up
Yeah.
on these things when the CAGR of any asset class becomes low.
Sure. So, basics always work. That's the thing with every process that you follow in life, right? So, last question before we let go of this interesting conversation, Shridatta. Are there any sectoral thematic trends you believe are currently underappreciated by the market? If you can quickly tell us that in terms of a quick revision for our viewers as well.
I think in terms of valuation overall, there is no underappreciation. But in terms of pockets, clearly, while statistically they are not cheap, but mass consumption part of the market, low ticket mass consumption items, whether it is staples, whether it is consumer durables, whether it is your building material, some of these spaces, and we're just giving indicative kind of list, where over last 2-3 years the earnings have been relatively weak. That part of the market, while statistically it is not cheap, it seems like a part of the market which is relatively more underappreciated. That is one space. Second is, and exactly contrary to this, is part of manufacturing, where probably some of the companies eventually will become part of the global supply chain, and so scalability is very high. Statistically, they look very expensive today. Again. But the opportunity pie is expanding, and the opportunity pie is far larger for them than what people are actually thinking today. And I think that's the combination of the part of consumption and part of manufacturing, which both sides I see some underappreciation. Although in most of the other parts, we don't see valuations being really very, very comfortable. They are largely in fair zone or expensive zone.
Okay, those are some of those interesting themes maybe you can keep an eye out on. Thank you so much, Shridatta, for joining in with us this afternoon, giving us your insights in terms of how one could look at mutual fund strategies. But with that, we're absolutely out of time on this edition of Mutual Fund Corner on CNBC TV 18. Thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade.